Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Well, hello and welcome to the Better System Trader podcast. Glad you could join us today, where we're going to be talking about holy strategies and portfolios. Now, when I say holy, I'm not talking about religion or divine intervention, holy grails, or anything like that. Although we probably could apply today's topics to those types of strategies that need divine intervention, and who hasn't had a strategy like that at some point. Now, when I say holy, I mean something with a hole in it, like a bucket that has a hole in the bottom. And when you put water into that bucket or some other liquid, obviously it's going to start leaking from that hole, reducing the performance of the bucket. So today we'll be discussing holes in trading strategies and portfolios that could be reducing trading performance. And joining us for this chat today is special guest Ryan Moffat from Black Pear Capital. Ryan has spent the last 12 years specializing in designing and trading robust strategies, working with and being mentored by traders out of the CBOE as well as hedge fund managers out of New York and California. And some of the things you'll discover in my chat with Ryan today are why manual backtesting can be more beneficial than automated testing. Ryan also shares how deliberate practice can be used in the strategy creation process to get a deep understanding of a strategy. We also talk about how to find holes in a trading strategy that could be punishing your trading performance. And Ryan also shares with us the holes in people's portfolios and how allocating a small portion to the fourth asset class can be a good hedge for a portfolio when other markets aren't doing too well. Plus, we cover a whole lot more as well. So let's jump over now to my chat with Ryan from Black Pear Capital. Hi, Ryan. Welcome to the show. It's really great to have you here.
Yeah, thanks for having me. It's great to be here.
So let's just start off by getting to know you a little bit better. Can you give us a little bit of background on yourself and how you actually got it started in the trading business?
Yeah, it's kind of been a long journey, just like most traders. I was in land development. I guess first I kind of came up through an athletics background and played kind of a higher level of baseball in college, and so that really added to. I'm a very competitive person from an athletics background, but kind of after out of college, kind of get into land development, but kind of growing up and everything, I loved the markets. I loved kind of the meritocracy of markets. I love the flexibility of markets and kind of the endless rabbit hole that you can get into. I love challenging myself. So really when I was in land development, I was doing very well, and it's pre-08. So, anything in real estate was doing very, very well, but I knew it wasn't my be all end all. I knew really where I wanted to be. So actually ended up leaving that job and going out on my own, actually in the same kind of real estate venture as well. But I went with a partner kind of on our own, and we actually ended up failing miserably doing that. So it was an interesting learning lesson. It was actually an incredible learning lesson. But when I did that, when I really started failing, I knew that I didn't love what I was doing. And that's really one of the biggest reasons I was failing at it, because I wasn't pouring everything I could into it. And anytime you're on your own or doing your own venture, entrepreneur, or doing your own business, if you're not fully 100% committed, then it's never going to work, period. And so found that out the hard way, bleeding money. And then I kind of had what I'll call my park bench moments where I kind of sat down and, was bleeding money. At that point, I had my wife, and at that point I had a six-month-old son. And was just kind of looking to say, it's like, okay, well, I'm not doing what I love and I'm failing at what I don't love. So, up to that point, I was always looking like, I want to make a lot of money so I can do X, right? I want to make a lot of money so then I can do what I want to do. And so at that point, I kind of flipped that and said, okay, well, let's not worry about the money right now. Let's just do what I want to do. And at least if I don't make a lot of money, at least I'm doing what I want to do. And so at that point, some of the best people to ask of what you should do with your life is the people closest to you. And that's kind of what I did with my wife. And she kind of brought back what I already knew, which, I'd read old finance books for fun. Every time you go, to the bookstore, look at what you go towards, right? What do you read at a bookstore when you're hanging around? Well, I'm always reading, about hedge fund managers. I'm reading about trading. That's all I ever really read about and was interested in. So then I just kind of started my venture and, didn't really know exactly how that was going to be. I just knew what I wanted to do. And then for me, what crystallized the entire thing was I saw a PBS documentary about Paul Tudor Jones called Trader. It's an old 80s documentary. If any trader hadn't watched it, you need to see it. And it really crystallized exactly what I want to do with my life, because it is an absolutely incredible documentary of PTJ in his height, before the crash, and shows exactly him in it, passionate, but also his passion to give back, which obviously now he's got the Robin Hood Foundation, but then it was a little bit different. But just seeing that and seeing that you can really, if you do well at trading, you can really make an incredible amount of money. Just seeing that really crystallized everything. And that started my journey. And then the journey from there, I ended up, I'm from Knoxville, Tennessee. So there's not a lot of hedge funds in Knoxville, Tennessee, as you can probably imagine. There just aren't. So I cold called 50 hedge fund managers around the country. It wasn't just like one call or an email. It was like literally hounding people. Because, it's amazing when you get clear on what you want to do. When you get the why, the how isn't that big a deal. You just do what you need to do. And so that's what I did. I cold called, and then I got, 3 of them called me back, or actually kind of got a hold of them, and they got a hold of me, and 2 of them still mentor me, kind of have a mentorship to this day. So they still help me out. And it's guys out of the CBOE, Chicago Boards Options Exchange out of Chicago, and hedge fund managers out of New York. And that really kind of got me started on that journey of trading, of what trading actually is, what risk management actually is versus, quote unquote, being an advisor or something like that. The trading world is totally different. And I was just eating it up. And then, fast forward, 14 years later, here we are. So that's kind of the beginning. And then it just progressed from there. I wish it would have progressed faster, but then when I look back on it, I'm glad it didn't, because I needed to learn a lot of hard lessons before you ever, take outside money or anything. So, I ended up getting my MBA, and then and not saying that you need that to be a trader at all, but for me, it was an industry shift. So I ended up getting that and got some good contacts there. But really, it was just a progression of, just like any trader's journey, of doing it yourself, and then, results and getting comfortable and learning. And then we took, we've only had outside money for the last, 4 or 5 years. So it was a decade before I had probably enough experience enough to take on outside. And that wasn't a lot of outside money then. So, and then over the last 3 to 5 years, it's progressed, just a learning curve, and, our team has progressed. So I would say that's about a 15-year span from beginning to where we are now. So, in a nutshell, that's kind of where I've come from.
Yeah. So when you were chasing up those, I think you said that 50 hedge funds that you were chasing up, and a couple you responded. What do you think it was that they saw in you that wanted to kind of help you out there? Because I imagine that they probably get tons of emails every day and people chasing them all the time. So the competition space is pretty tough there. So what do you think it was that helped you to kind of bubble to the service and be noticed?
Yeah, that's a great question. And I think a big part of it was, persistence is a big part, obviously. No is really not my vocabulary a lot of the times. So if I really need to get somewhere, but I think a big part of it was me doing something for them, not me asking for something from them. It's let me help you. Let me be of value to you, because everyone's busy. But if you're adding value to them, then they will take time out of their day to do that. So for me, it was doing projects for them, Excel project, whatever needed to happen, I was going to make happen, whether I knew how to do it or not. And that's really where it came from with the guys that really I got a hold of, is really giving them some value, utilization. And then, throughout the years, I've had other mentors that I've paid for, right? I've actually paid for them. But the ones that I've really had a real partnership with, it was because I added value to their day. And I wasn't kind of calling them up or emailing saying, hey, can you take a lot of time out of your day to help me and get nothing in return, Yeah,
it's not appealing, is it?
It's not to anybody. And so, and if you just think of it as a sales, like if I'm going to sell myself, why would someone take their time out of the day, especially someone that's extremely busy and extremely successful? And it's just that type of things. And another thing is, when they gave me something to do, I did it. So if they gave me something to read, I read it, and then 3 other books on top of it, and then let them know exactly what I got out of it, so that they knew I wasn't wasting their time. Because, one thing that we see a lot is people that talk and then people that do. And the people that do will continually be successful because they don't talk about it. They just do it and get it done. And so I think that was a big, because there's not a whole lot of people out there that just don't talk, they just do. And I think that was something that they saw in me at that time, that it was like, okay, this kid is not going to give up, and he's going to get where he needs to go. And if we give him a task to do it, and he's going to do it. So I think those few things probably kind of culled through the weeds. So it got me some responses.
Yeah, cool. So there's a lot of great tips there for people who are trying to get some assistance there. So thanks for sharing that. Yeah, cool. Yep. So what about now you're trading today? Can you give us a little bit of an idea about the types of markets and the timeframes and the styles that you're using?
Yeah, absolutely. So as I mentioned, my mentors really came out of the pits of Chicago, so the CBOE. So they're trading options pits, and that's really our bread and butter is options. And so our real bread and butter is trading broad-based index options from the Russell 2000 and the S&P 500. So it's the SPX contract and the RET contract, RUT contract. And those are really the two that we trade. And so the liquidity is very deep in those. And we do have a lot of contracts that we trade, but we are spread traders. So if you're not too familiar with options, you can put options together and form spreads, and you can have kind of complex structures such as butterflies or condors and mix and match. And really what you find out, it's really you're just putting options together to get certain exposures and certain risk rewards that you want. And the beauty and what I love about options, and you'll see I'm very passionate about options, is the flexibility you have with them, and you can get very efficient and very effective risk reward and very effective positioning with them. And so that's the background that we came in. And so really our trading today consists of we've got about 5 or 6 different actual strategies, and all 6 strategies are options based, but they're all going to serve a little bit different purpose for what we want from that exposure, or what we want that trade or that strategy to produce. And when I say exposure, I'm saying, okay, do we want something that has bearish exposure that does well in these type of markets, or something that does well in another type of market? And so what we kind of prescribe to is if you're familiar with the Ray Dalio, the risk parity model, or if your listeners are kind of familiar with that, where you're putting different strategies together to form a portfolio, and you have strategies that are uncorrelated with each other. And when I say uncorrelated, it kind of gets lost sometimes, because you have people that just own stocks and they think their stocks are uncorrelated. But in essence, stocks are an asset class. They're just one asset class. So when volatility hits, their correlation pretty much goes to 1. What I'm talking about is strategies that fundamentally make their money in different ways. So one that's bearish, one that's bullish, and understanding how those strategies work from the ground up. So understanding of why they make their money, how they make the money, what environments they make their money in, how they do, and then pair those in different allocations to form a portfolio. And that's kind of a little bit, 10,000 feet what it is. And then obviously we can dig in as much as you want on how we do it and all that. But that's just kind of a 30,000 feet of what we kind of look for as traders.
Yeah, sure. So I think we will dig into the diversification and the uncorrelated assets in a sec. But first, I just want to start with strategy development. Now, testing option strategies can be challenging sometimes. So how do you go about developing winning strategies, especially if you're trading options?
Yeah, options are it's a rabbit hole because instead of dealing with your stock that you make money if it goes up or lose money if you go down if you're long the stock, options are really a 3-dimensional and 4-dimensional beast. You've got time, you've got volatility, you've got direction, and so you're really kind of handling a few different things. So you do need to get kind of used to how they move, but when you're actually testing them, we've got software that we use. You've got different ones out there, but you've got OptionNet Explorer, you've got OptionView. Those are the two that we use kind of more for the back testing. You've got some automated back testing ones as well. What we like to do is we like to manually back test it, meaning we click through day by day, and we do that for a specific reason, because what we want to do is however we're going to trade it live is exactly how we want to test it. And that goes with how we look at it day by day, what time we look at it throughout the day. We want to make sure, kind of coming off the assembly line or from the testing to the live testing phase, that there's really no difference between the execution. And so that's very, very important with us, because we want to be able to scale it if we can. We want to make sure the process is very scalable, but also repeatable. And so what we want to make sure is we can literally have our process and hand it over to someone that didn't develop it, and it'd be executed the exact same way. So that's how clear we want to make sure our process is. And I think all our traders know is when your process isn't clear and you've got money on the line in your position, your mind totally gets scrambled. So if there's something that's unclear, the market's going to sniff it out, and it's going to sniff it out the worst time possible. So, and the only reason we know that is because we've spent 10 years doing the wrong things, right? So we kind of get through everything wrong to see what actually works. And so, from the ground up, when we develop strategies, we want to start with what we're trying to achieve with the strategy. And that took a long time to figure out because a lot of people's like, I want to develop something that makes a lot of money. Well, that's kind of hard to dial in there. So when we develop strategies, we want to develop something that has a specific purpose within our portfolio. So, for instance, we wanted something recently that had very, very low drawdowns. So we've got 6 different strategies, and we can dig into what kind of each one kind of aims for. But with this current strategy, we want something with very low drawdowns. We know that it's going to have lower returns because of that. But we want the drawdowns to be a certain way and act a certain way. And so what that allows us to do is be very specific in how we create the structures. And a lot of times we'll create something, test it, and it doesn't work. And so you got to go through it's a lot of work. And so you just go through iteration after iteration. And what you want to make sure of, just like anybody knows, is you don't curve fit, but you fundamentally understand what's going on and how the strategy is making money. And for instance, if you've got a strategy that is, let's say, a range-bound strategy, it makes money when the markets are range-bound. Then if the market breaks out, then don't be surprised that it loses, right? It's not that the strategy is broken. It's just the environment's not conducive to what it's made for. And so those are the sort of things we look for is, okay, we want something with bearish exposure that limits its losses when the market's extremely bullish. That we want to look for this sort of drawdown. We want this sort of return. We want this sort of risk reward. And then we really it is iteration after iteration. Well, let's try this. Let's try this. And after years and thousands and millions of data points, you start figuring out kind of what works. And so your processes get quicker and quicker and quicker. So now versus 5 years ago, our processes are a lot quicker, but you still have to do the work, right? And that's what we call deliberate practice, where it doesn't feel good to do. It's not fun to do, but that's what makes you money, because that's what creates the strategy for you. That's what makes it. That's what gets your head around exactly what's going on. Because when the money's in the market and you're trading the strategy, you shouldn't have any questions pop up. You will in certain points to make sure, with markets changing and everything. But for the most part, you should always know what's going on in the strategy. And if you don't, it shouldn't be traded live at that point. Does that make sense?
Yeah. So then if you're building these strategies for specific purposes, perhaps specific market conditions like range bound, as you mentioned, do you have specific filters in there to define what conditions a strategy will work in, and you switch it on and off, or how do you actually manage the changes in market conditions?
Yeah, that's a fantastic question. And it's kind of interesting because we've got 5 guys on our team. And what's really cool about having a team is you have people with different backgrounds and they look at the markets differently. So it's really nice having that team environment. So what we try to do is, instead of trying to figure out, instead of trying to figure out how something would change with the environment, is when the environment is not conducive, limiting the losses as quickly as possible. So instead of let's say our strategy would change in order to change itself to the environment, we would just have a different strategy for that different environment. So what we do is we categorize the markets into really 5 different categories. And really when we say markets, I'm talking about the equity markets, the S&P 500 and the Russell 2000. So those are our instruments. So that's when I say markets, that's what I'm talking about. So generally, there's only 5 things the market can do. The market can go down quickly, so like a crash. The market can grind down. The market can go sideways. The market can grind up, and the market can scream up or crash up. It can go up very quickly. So we want strategies that cover those 5 market conditions. And when I say market conditions, generally our trades are going to last about 2 weeks to about 45 days. So we'll say about a month average is so in that 30 days, what's the market condition? And so if we've got a strategy that does really well, if that market condition is, let's say, grinds down, sideways, or grinds up, so that's 3 different market conditions it can cover. I want to make sure that if the market screams down or screams up, I understand that it's going to lose, and I'm okay with that, but it just can't lose, everything, right? It's got to just limit those losses. And so what you start finding out, and this is where the testing comes in, is that's what you start figuring out is where the limits are. And again, it's really just personal preference. Where do your drawdowns want to be? And so that's really kind of how we look at it, is we want very robust strategies that will do well in 2 to 3 to even 4 different market environments. So something that does well during a crash and grinds down, does well sideways and does well grinds up, but maybe really has a really tough time if the market screams up. Well, that gives us flexibility to put that strategy with another strategy that does well with, let's say, something that grinds up or screams up and sideways. So now we've got 2 strategies that really are covering the entire spectrum of market environments. Now all we've got to figure out is how do we want to allocate the money to them, right, as a portfolio. And so that's really kind of how we look at it. Now the intricacies of actually like, okay, what verticals and what butterflies do we put where and everything, that's what takes the most work, is understanding that, but also making robust enough and taking what we want to do is make it as mechanical as possible. So take discretion out of it as much as possible and make it as data driven as possible. And so that we are very data based when it comes to, we want as much data. We want it to be statistically relevant as much as possible.
Yep. Now you mentioned there that you've got or you try to build strategies that can perhaps work across different market environments. How do you then manage that, or how do you determine that a strategy is starting to fall apart when you're trying to fit it into a couple of different environments?
Yeah, I mean, what we see, and that's why options are very nice, because generally with our structures, for the most part, they're going to be range-bound structures. So, for lack of a better term, that they will have a range that they can cover. But one thing that you realize is within that strategy, we will move with the market. So we can cover a large range of movement. And there's just only certain movements that really punish a strategy. And so what you see is when we test these strategies, we want to test them over multiple environments. So if we don't have the data of a certain environment, and what's really nice over the last 20 years, we've had a lot of different environments. We've had 2008, we've had that sort of a crash, but then we've had, February of this year, 2011, 2015, where you've got certain crashes, but then you've got a 2013 when the market goes straight up with low volatility, 2017. So in essence, those 5 market environments are kind of represented somewhere within those 20 years, with the understanding that the market can do whatever the market wants to do, whenever the market wants to do it. So what gives us a lot of confidence is, first of all, testing through environments to see how they react, and to see it and to get that statistical relevance is like, okay, well, in this sort of environment, these options will be conducive to these certain conditions. But also with experience, you start feeling out, it's like, well, because options act in a certain way, you can really start understanding, well, if the market does this, well, this is how they're going to react. And so you can kind of create those structures to just react as you need them to. I know it's kind of a roundabout way of looking at it, but that's kind of what gives us the different market environments, is testing it through it. So, where we are now. So what does the last 4 months look like in 2018? Well, if you look back, it looks a lot like 2011 when the market crashed and then really chopped around. The options pricing, the options markets are reacting a lot like they did back then. And it's kind of interesting because you've got a crash in 2015, but it's not acting the same. So for us, it's continually trying to get more data and get more market environments, but also, again, just continually testing through each environment, continually testing through different environments, and just fundamentally understanding how an option is going to work. So, for instance, if you buy Apple, just the stock, and the overall market goes down and tanks, well, most likely Apple's going to go down too. And understanding that, it's like, well, don't be surprised at that. I mean, don't be surprised that, that's going to happen every once in a while. It's like going outside and expecting it never to rain. That's just part of what the market does. It goes up and goes down. And just having that understanding of like, okay, well, these things are going to happen. So we just need those fundamental, those strategies in order to take advantage of that. For instance, a bearish butterfly, generally a butterfly behind the market that's bearish will do well when the market goes down, flat out. And so if you literally cut your losses on the way up and let your losses run, or let your winners run on the way down, it's a profitable bearish strategy. And that's fundamentally how it will make its money. And so stuff like that is just putting those sort of trades together that fundamentally make money in the different environments in a good portfolio. Yeah.
So once you're trading these strategies, you mentioned that you're always looking for more data and testing new ideas and refinements. How do you manage adjustments to the live strategies over time?
Yeah, that's a really, really fundamental question. Slowly, we manage them very, very slowly, because it flat out, if as soon as you change something, it's going to be the worst decision you ever make. I mean, that's just trading 101, right? But it is. I mean, not saying that you never need to change anything, because you do. And we've got strategies right now that we're looking at the exact same thing. It's like, okay, well. And I think a big thing is if there's an environment that you've seen the strategy do very well in, and then you see a market environment that is very similar to what you've seen prior. And when I say environments, you've seen it in those environments multiple times, and now the strategy is not doing the same thing, meaning it's almost doing the opposite. That's when you start questioning, right? So, from the prior example, let's say a bearish butterfly, a butterfly that does well when the market goes down. Well, if the market goes down and the butterfly does not do well, you need to start asking questions. Why? What's going on? Because that fundamentally goes against how this strategy should be making its money. If you've got a bearish strategy and the market's been careening to the north, right, going up, and it's losing money, well, there's nothing really to react to there, because the market's, that strategy is not supposed to make money then. But I think when you're in an environment that it should be doing very well in, and it's not, I think that's when you really fundamentally start asking questions like, okay, what's going on under the hood? And you should know, because you built the strategy. And so you should know, pulling it apart, putting it back together. It's like, okay, what's going on? Why isn't it making any money? Is it a fundamental change in the market? Is it a fundamental change in the strategy? And all this, is predicated on the premise that you're following your strategy, right? And that's one thing to take note of, is the biggest thing that us and our traders, which goes without saying now, but we see it with newer traders, is we have so much pain connected to not following a strategy. It is way more pain than any loss will be, period. So the only thing we have is our data and our strategies. And if we don't follow them, then you're completely off the map. You have nothing. All your data is for nothing. And so that's one thing, is as any new trader, any trader out there, is if you're not following your strategy to a T, then there's really nothing to measure. You have nothing to measure. And so again, I just wanted to kind of put that out there, because we take it for granted sometimes, that our traders literally, we're like employees to our strategies. We will do exactly what they say. And we do no sort of, on the fly sort of decisions that just doesn't fly with us. So,
yeah, you raised some really good points there, Ryan. Thanks. Now let's move on to diversification. You've already kind of touched on a little bit about portfolio construction and uncorrelated assets. Now, something I noticed on your website, blackpearcapital.com, there's a statement there which I want to ask you about. That statement is, the fourth asset class is the missing piece to traditional portfolios. Can you explain what is this fourth asset class that you're talking about there?
Yeah, absolutely. So when we talk about the fourth asset class, there's a lot of different asset classes out there, but most people that we've seen in clients, partners, will have traditional portfolios, which consist of mainly three asset classes, which is stocks, bonds, and real estate. And most people are very familiar with those, how they react. And so generally with equity markets, every asset class has cycles, and it does well in certain times, does less well in other times. And that's just how it is with pretty much every asset class. So when we say the fourth asset class, what we really found is there are massive holes in people's portfolios. And that hole is when equities don't do well, when volatility is high, or the markets go sideways or go south or just don't do very well. There's really nothing in a portfolio that fundamentally makes money when the equity markets are in a tough time. And so what I mentioned earlier is with options, you can create structures that literally they mop up in those sort of times. So when the market is a little bit more volatile, or the market's going down, the market's going sideways, or is choppy, or just grinding around, the strategies that we create are incredible parts of that portfolio that plug that hole. And because I think a lot of times people, especially with stocks, they say, I want something that does less bad when the market goes down. So I want blue chip stocks or something that does less bad. What we're saying is, like, why don't you get something in your portfolio that does incredibly well and have it as a small portion of your portfolio? That way you've got something that fundamentally makes money and does well when your equities or your bonds aren't doing very well. Now, real estate is a little bit different because obviously that's a little bit, you can take that as certain ways, but that's really kind of where we fit with our partners is having that small portion of portfolio that does well. And coming from a trading background, and I think a lot of traders kind of feel this way, is, we look for, higher returns than I would say most people are out there. I mean, I think a lot of traders aren't extremely excited about a 3 or 4 or 5% annualized return. And neither are we. So our strategies, we look for higher returns. We want something that's going to annualize, 20, 30, 40, 50, 60, 70. I mean, our strategies, depending on which one you're talking about, will annualize 90, 100%. Now, obviously that comes with volatility as well, and drawdowns, but that's why we kind of put them together in different allocations. But what we want to do is we want to have something that has higher returns, a small portion of your portfolio, and it's a good hedge for a portfolio because it does well when, let's say, equities aren't doing very well, going sideways or what have you. So that's where we come up with the fourth asset class, something that does well at different times than the other three asset classes.
I suppose that goes back to your point you made earlier about designing different strategies for specific purposes, and you're really looking at that not just from a strategy level, but from a portfolio level as well, right?
Yeah, absolutely. Coming from a trading background, I also have experience. I've worked with, some large regional investment firms. So I've worked with institutions as well. And so that gave me great experience in how you've got your mechanical portfolio based kind of mentality. And so what we've tried to do is kind of pair those together. So the trading mentality of really eat what you kill, which we love, we're performance based. So we eat what you kill. Which is where we've come from, but also put that together in a portfolio sense and plug these massive holes in people's portfolios and do it in an efficient way, which is kind of our aim.
Yeah. So this fourth asset class then do you think options are the only way to do that, or are there other alternative assets that can assist to plug those holes?
Yeah, I mean, obviously it depends on each portfolio. And, again, we're not the be all end all. We are very specific in what we do. What options do allow you to do is really get different exposures from the market. So you can create something that fundamentally does make money in a bearish sort of way when the markets move down. It just gives that flexibility. Obviously, that's where my experience is. But I mean, you've got other asset classes as well, like managed futures, right? With CTAs, they'll do well when the market really trends one way or the other, right? If it trends hard to the south, they will do very well as well. But you're going to have different asset classes. And, we come from the risk parity, Ray Dalio, Bridgewater type mentality of, literally if you can get, 5 to 6 to 7 to 10 asset classes that are fundamentally different, you get rid of 90% to 95% risk in your portfolio because they all work differently with each other. And you just rebalance that. And it's amazing what it does. And what it does for people with a portfolio is you don't think about trying to quote unquote beat the market. You just have things that do well at different times in different markets. And so something, if not a few things, are going to be doing well at any one time. And that's what a true, diversified portfolio is. So we just want to be a small piece of that because our expertise is in the option space and our bread and butter is Russell and SPX. And so the more specific we have gotten as a firm and as traders, the better and more effective we've been.
Yeah. Now, there's another statement that you have on your website, which I wanted to ask you about. and that was growth and protection. And I think at times these can kind of appear to be at the opposite ends of the spectrum. So how do you go about balancing the two together?
Yeah, I mean, it's kind of interesting. You can say growth and protection, but really it all boils down to growth, right? Only thing protection is having something that's growing while something else is dying, right? I mean, that's your protection. That's your quote unquote hedge, is because a hedge will make money, or let's say insurance. Insurance will pay off when something has burned down and something. So really protection, all that is growth in a different manner. And so what again, kind of going to the fourth asset class is, we'll have something that's growing. Let's say let's say a 2008 sort of environment where the market really is just getting, just beaten to death, and it's down 30%, 40%, 50%. Well, that was a lot of our strategies. That was some of their best years. And so when you say, you have a small portion of that, and that's going to protect, a good portion of your portfolio. And that's kind of why we call it the Atlas strategies. If you're familiar with Atlas, he holds up the world. Well, that's really what our strategies are supposed to be, are targeted to do, is really hold up a portfolio of equities and bonds that don't have anything else that helps it in those sort of environments. And we do have strategies that do well. We're going to have strategies that do well in most all environments. But our bread and butter is to be that whole that's going to protect your portfolio with when you have those equity environments that aren't doing too well or grinding or what have you. But also the growth is there, and that's the whole point. Is when you have a small portion of portfolio that outperforms and grows quickly, it can do incredible things for your portfolio in a more efficient way. And what we see is we see a lot of people take a big chunk of money and put it in something that's very low volatility and get some, 3 or 4 or 5 or 6% a year, when you could literally take a tenth of that portfolio, put it in something that returns 20% of the year, have the rest in cash. You've got a less volatile portfolio, but have the same overall return. And so it's a different take on risk, and it's a different take on volatility. And a lot of people think volatility is a bad word. We see it as opportunity. And so that's kind of the way we relate to it.
Yeah, I like the way you look at that. And also I like this idea of thinking about where the holes are in your portfolios and the types of market conditions which could identify those. So for traders who are kind of thinking about these type of things, considering diversification and portfolio construction, what would you recommend they do? How do they go about starting that process of considering what they should do as far as diversification?
Yeah, I mean, just fundamental questions. So let's say you have a stock portfolio. Well, if the market goes down 50%, how's it going to do? Is it going to do well? Is it not going to do well? And, if it goes up 50%, how's it going to do? And just asking those fundamental questions and don't leave any question out. Don't think anything's not going to happen in the market. What if the market drops 50% in a day and closes for 10 days? So those sort of things, we look at our portfolio like, okay, do we have everything covered? Do we have crashes covered? 30% day, 30% down day, 50% down day. What about a 30% up day? What about a sideways market? What about an up market? So just asking those questions and really stress testing a portfolio. Stress test what you have. If you've got stocks and bonds, well, how do those react? Because a lot of people assume what the market's going to do, but do they really have their bases covered? And again, I think the bigger reason why we do that is, first of all, that's what my mentors came from, the pits, where they pretty much ate what they killed. So they had to have strategies that did well in primarily most all markets. And we're the same way. We're performance based. So if our partners, and if we don't make money, then, my 2 boys, they don't eat, right? So they like to eat. So we need to make money. And so that's something that it is. And one thing that we really harp on is anybody will go with unconsciously or consciously where they're incentivized. So if we're incentivized by performance, that's where we're going to put our effort is day in, day out, is figuring out the holes in our portfolio or the holes in our strategies and plugging them or creating new strategies to plug them. And so I think that's a good exercise for any trader to go through, is to look at your strategies and a multitude of strategies and say, okay, do I have all my bases covered with all the market environments? I'm not saying that you never, you're going to have to get to a point and then you stop, because you're always going to have to keep iterating. But I think that's a great exercise to continually do.
Yeah, I agree. So I'd just like to start wrapping up now with some quick closing questions.
Yep.
Okay, the first one is, what's the biggest lesson that you've learnt through trading?
I think through athletic, I was from baseball as well, but athletics is, and I kind of give a couple lessons, is one of them is failure. Like when trading, losses do not mean that you're wrong, and being right and winning are not the same things. So kind of filter through that is a big lesson to understand. I think one of the biggest ones is the result does not mean that the process was bad or good. So when I say that, so I have a losing trade, that does not mean that my process was bad. And so separating the results from the process is one of the biggest things that you learn. I learned that in baseball, because in baseball you can be wrong 7 out of 10 times and you're an all-star. And that is a lesson in trading that takes a while to learn. But when you start learning it and you start putting in your process, first of all, it takes the pressure off. And second of all, you start getting, there's no right or wrong. There's just results and feedback. And so in this, always, again, it's predicated on you following your trade plan. Create a trade plan, follow your trade plan, see the result, go back to square one. If the result was what you wanted, continue with the trade plan. If it wasn't, go back and see why. And that's a very simple way to go about it. It's not easy, but it is very simple. So that's one of the things that I really learned from trading and from athletics.
Yeah, it's interesting, actually. I was just thinking about there's quite a few traders that we've had on the podcast who have either come from athletics backgrounds or even musicians in previous careers. So I'm not sure why that is. I think perhaps that
I think it's failure. I think you learn how to fail and you keep going. I think that's one thing in trading is really understanding is failing and keep moving forward. And it's a hard lesson learned. Because it's funny. My brother's a musician. I play several instruments myself, so it's funny you say that. Yeah.
Wow. Yeah, cool. Next question: what's the best trading advice you've ever received?
Oh wow.
It's probably lots, right?
Yeah, there's a lot. I think some of the best trading advice when I hear it at first, I'm like, yeah, that's fine, and then 10 years later, I actually get it. But I think one of the biggest things is take your time. So, and enjoy the process, enjoy the learning. One thing that I was really, bad about is I'd want to speed everything up. And like I said at the first, it took 10 years before we ever kind of took outside money, and it needed to take that long. It did. Because you need to get your lumps and you need to do it because you want to do it with small amounts, and you want to do it with your money or no money at all, in order to learn. Not saying you're going to get to a point you don't learn anymore, but I think that's, enjoy the journey is one of the biggest things. And, take your time. Just so many people they want to speed it up and put money at risk. And it's funny, the more as years go by, our process gets slower and slower. Like we want to take longer and longer before we put any sort of new strategy in because we want to test it more. And what's kind of interesting is one of my traders put it the right way. He's like, man, you talk to some traders, and it's the difference between NASA and testing everything before they put a man in space, and that's the way we want to be. Versus some traders are like building a catapult and just catapulting somebody into space and expecting it to work, But when you think about it, when you really dig into some like trade plans and stuff, it's like, well, if you say like this is an actual business plan and you put it in a totally different industry, nobody on earth would give you money to start that business. Yeah. And there's no difference between a trade plan. And so if you treat it like a business, that's another good, some really good advice I got is treat it like a business and take it to somebody, that you trust and say, would you invest in this business? And if they wouldn't, go back to the drawing board. Do it right.
Yeah. Great advice. Now, you mentioned earlier that you've read quite a few trading books. So do you have any favorites that you recommend other traders?
You got to go with, Market Wizards, right? That's key. Reminisce is a stock operator. Those two are key. And I think the biggest things you learn from those is making strategies your own, right? Is is you're always going to learn from other people, and you're always going to take, but you need to stand on their shoulders, but you got to make it your own, because just like I mentioned earlier, you got to fundamentally know what's going on with your strategy, because when you're sitting there and you've got tons of money going against you, you got to have the fortification of, because you've built the strategy, you know exactly what's going on. And those 2 books, I mean, on top of the greatest, some of the greatest traders in the world, but those 2 books are, key. I mean, I could probably recommend about 250 different books. But I mean, and that's another thing too, is the best traders I've known are constant readers. They read all the time, and all kinds of different books. Some of our best ideas don't come from trading books. They come from all kinds of different genres and everything. So, but I think those are the go-to if someone hasn't read them. You've got to start with Market Wizards or Remnants of the Stock Operator.
Both classics, yeah.
Yeah.
So if listeners wanted to learn more from you or get in touch with you, what's the best way that they can do that?
You can email us at info@Blackbeard Capital, or email me directly at rmoffett@blackbeardcapital.com. That's RMOFFETT. That's my direct email. So any questions or anything? I mean, I wouldn't be where I am today without a lot of help from a lot of people. And so anything that we can do to help or forward or something. But I will say, take my advice, and if you are wanting some advice or wanting anything, add some value, right? Put some value out there, and we love to help, and we love to work with good traders. And I actually found one of our traders through a podcast. So we ended up working together, and now he's a huge part of Blackbeard. So we love it.
Yeah, cool. Awesome. Well, it's been really great having a chat with you today, Ryan. Is there anything else that you'd like to mention before we finish up?
No, I just appreciate being on, and hopefully some of these things have helped some people and get forward, and people can make a ton of money. Yeah,
awesome. All right, well, thanks again for spending time with us today. It was great having a chat to you. So thanks again, and I wish you all the best.
Great. Thanks, Andrew.
All right, cheers. Okay, well, that's it for this episode. Thanks for listening. I hope you enjoyed the show. Come on over to bettersystemtrader.com. That's where you'll find all the previous episodes, all the transcribes, all the show notes, and all the free weekly trading tips. bettersystemtrader.com.